At 8:34 a.m. Eastern Standard Time this morning, the Office of the Superintendent of Financial Institutions, OSFI in Canada, issued an emergency directive that sent shockwaves through Wall Street, the Federal Reserve, and all major financial institutions operating across the U.S.-Canada border. This directive, issued under the authority of emergency cabinet orders signed by Prime Minister Mark Carney at 6:15 a.m., immediately imposed restrictions on U.S. financial institutions in Canada. It froze certain categories of cross-border financial transactions pending review. In practical terms, Canada severely restricted the ability of American banks to operate on Canadian soil and limited the movement of money between the two countries, a move that will have serious consequences for U.S. financial institutions with Canadian operations. This is not just a symbolic action or a warning shot. Canada is using financial regulation as a direct response to President Trump's policies. This represents the most aggressive economic countermeasure Canada has deployed in this ongoing crisis. The financial conflict between the United States and Canada has just escalated to unforeseen levels, and it will likely have significant repercussions for some of the largest U.S. banks. In this video, I will break down exactly what Canada's directive entails, which U.S. banks are affected, and why this has caused bank stocks to plummet. I'll explain why Canada chose this moment to target the financial sector, the legal mechanisms allowing Canada to impose these restrictions, and explore three possible outcomes for this financial war, including the worst-case scenario, a full decoupling of U.S. and Canadian financial systems that could lead to a cross-border banking crisis. Subscribe to stay informed, leave a comment to join the discussion, and share this video if you found it valuable. Let's dive into the details of the OSFI directive, as the implications are huge. The directive has three key components. First, enhanced scrutiny for U.S.-based financial institutions. Any U.S. bank, investment firm, or financial service operating in Canada must now submit to intensified regulatory oversight, providing detailed documentation of all Canadian operations, cross-border transactions over $10,000, derivative positions, and exposure to U.S. government securities. This documentation must be submitted within 15 days, and failure to comply could result in the suspension of Canadian banking licenses. Second, there are restrictions on new U.S. bank activities in Canada. U.S. financial institutions are immediately prohibited from opening new branches, acquiring Canadian financial assets, or expanding lending operations in Canada. While existing operations can continue, they cannot expand. Third, Canada has temporarily suspended specific cross-border financial transactions. This includes freezing all transactions between Canadian and U.S. entities involving U.S. government securities, Treasury bonds, or Federal Reserve instruments. Canadian pension funds, insurance companies, and investment firms are not allowed to buy or sell U.S. government debt until this freeze is lifted. The directive claims these measures are temporary, but they will remain in place until Canada believes its financial stability and economic interests are secure from external policy volatility, basically, until Trump backs down. This is devastating for major U.S. banks, many of which have significant operations in Canada, such as J.P. Morgan Chase, Bank of America, Citigroup, Goldman Sachs, and Morgan Stanley. These Canadian subsidiaries generate billions in annual revenue and are key to accessing Canadian markets. Freezing or restricting these operations would remove a major profit center for these banks. Moreover, the restriction on cross-border transactions involving U.S. government securities directly impacts the market for U.S. Treasury bonds. Canadian entities hold over $340 billion in U.S. Treasury securities, and if they cannot trade them, it reduces demand and liquidity in the market, which could lead to higher borrowing costs for the U.S. government. Within 30 minutes of the OSFI directive being issued, U.S. bank stocks dropped sharply. J.P. Morgan Chase fell 8.4%, Bank of America dropped 9.2%, Citigroup plunged 11.7%, Goldman Sachs lost 7.8%, and Morgan Stanley dropped 8.1%. Regional banks with Canadian exposure took an even harder hit, with KeyCorp falling 13% and Huntington Bank down 12%. The overall U.S. banking sector, as tracked by the KBW Bank Index, fell 6.9%. This is more than a routine market correction. It's a reaction to the real risk that U.S. banks could lose substantial revenue from their Canadian operations, coupled with the increased regulatory scrutiny they now face. Additionally, U.S. Treasury yields spiked in response to Canada's announcement, with the yield on 10-year Treasury notes jumping from 4.23% to 4.51% in under 2 hours, marking the largest intraday move in over 8 months. Rising yields mean falling prices, which reduces the value of existing Treasury holdings and increases the cost for the U.S. government to borrow money. This is a direct result of Canada's restrictions, which have reduced demand for U.S. Treasury debt. U.S. banks and financial institutions are scrambling to respond. CEOs of major banks are reportedly calling the Treasury Department and Federal Reserve, urging them to intervene. The message is clear. Canada's actions are causing significant operational disruptions, and if these restrictions last more than 30 days, some banks may have to shut down their Canadian operations and write off billions in assets. The U.S. government is scheduled to meet with these banks to discuss potential solutions. The Federal Reserve has also expressed concern. It issued a statement saying it is closely monitoring the situation and is prepared to provide liquidity support to financial institutions if needed. This is an indication that the Fed is worried about potential instability in the financial system if these restrictions persist. Why did Canada choose this moment to target the financial sector? According to sources close to Carney's government, this decision was strategic. Up until now, Canada has escalated its responses from diplomatic protests to trade retaliation to energy export restrictions. However, none of these measures directly hurt Trump's key supporters in the wealthy American financial sector. By targeting U.S. banks, Canada is hitting the sector that has the most influence over Trump and can apply pressure to him. Wall Street cares about profit, not politics, and if Canadian restrictions threaten billions in revenue and financial stability, Wall Street will demand Trump take immediate action to end the crisis. Canada is also sending a message to other countries. If it can restrict U.S. financial institutions and freeze cross-border transactions, other nations could follow suit. China, the European Union, and other countries could impose similar restrictions, further weakening the U.S. financial system. Now, let's look at 3 possible scenarios for how this conflict might play out. First, the Wall Street intervention scenario. Bank CEOs may push Trump to end the crisis to protect their interests. If Trump agrees to a deal with Canada, the restrictions could be lifted, and the financial crisis could de-escalate. But the damage to U.S.-Canada financial integration would be permanent. Second, the financial decoupling scenario. If Trump refuses to back down, U.S. banks may begin withdrawing from Canadian markets, and Canadian entities might reduce their holdings in U.S. Treasury bonds. Over time, the two countries' financial systems could decouple, leading to higher borrowing costs for the U.S. and reduced integration, with both countries suffering economically. Third, the contagion scenario. Other nations could follow Canada's lead, imposing similar restrictions on U.S. financial institutions. This could lead to a global decline in demand for U.S. treasuries and a weakening of the U.S. dollar. The U.S. could face a fiscal crisis as borrowing costs rise sharply. In conclusion, Canada's actions have sent shockwaves through the U.S. financial system, and Trump is left with few good options to resolve the situation.